Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hey, Paul, you want to make me a host as well so I can control things?
Yeah. Okay, let me do that. Yeah. Mm-hmm. You got it, Trev?
Yep.
Okay, yep. Perfect.
Hey guys, is my mic working?
It is.
Awesome.
Awesome. Trev, I don't know if you've got co-host capabilities. I wonder if you got any chance of figuring out how to record it.
Yeah, we're going through the same issue again, Paul. I think it's got to be done when it's set up. So,
well, it was. I know that for a fact. And then I don't know if it defaults back to not recording. So,
yeah, it should show a recording symbol that should appear in on the top corner of your space, and if not, then it's not being recorded. But
yeah, let me try one more thing here.
No worries.
No, that's not cooperating. I guess we'll just have to do what we can here. Well, we've got a few more minutes to try to figure it out here. So.
Yeah, we'll start right at 1:15. So maybe I'll see if I can find a solution here as well.
Yeah, go for it.
Well, Paul, I got nothing. I got no solution.
Get your old cassette recorder. Maybe we'll record it that way.
I know, right? Okay, should we get started?
Nice, yeah, go for it. Go for it.
Okay, well, first of all, hello everyone. Welcome to the Small Cap Discoveries Twitter Spaces. I'm Trevor Chweek. Your host here is Paul Andriola, CEO of Small Cap Discoveries. And today we're thrilled. We've got David Barr as our special guest. David is the president and CEO of Pender Fund Asset Management, a boutique investment firm based out of Vancouver, BC. At Pender Fund, David oversees the firm's investment strategy and manages several of its flagship funds, including the Pender Small Cap Opportunities Fund, which has consistently outperformed its benchmark and won multiple awards. David is a chartered financial analyst, a CFA, and has been recognized as one of Canada's top 40 under 40 by the Globe and Mail. David has over 30 years of experience in the investment industry and is known as one of Canada's best top small cap stock pickers. So, David, we welcome you to the show, and we look forward to learning from you today.
Well, thanks, Trevor. Thanks, Paul. Thanks for having me. Looking forward to talking small cap stocks.
Awesome.
Great.
I love it. I'm super excited to have you on, David. We go back a number of years, but you clearly have made a name for yourself and are sort of one of the go-to guys when it comes to the small caps, not just in Canada, but really internationally. Why don't we just start off by maybe having you tell us who you are and kind of how you came to be where you're at right now?
Yeah. So as you mentioned, I'm in Vancouver, so I'm kind of off the beaten track here. I started my career coming out of business school in 2000, and venture capital was really cool. It's kind of like 2020, but 20 years earlier. And started with a venture firm, and for 2 months it was the best, easiest thing you could possibly do. And then NASDAQ bubble blows up, and you realize how hard investing truly is. So, when you're starting in your career, it feels really painful to start like that. But in retrospect, it's so many valuable lessons you learn from periods of time like that. And what that really focused me to do in my career was, when I'm looking at those companies we were invested in 2000, we really quickly had to say, which companies are going to make it out the other end? Like if a company faces financing risk, do you actually want to take that risk on? And I think that's very comparable to the market we're seeing today for microcap and small cap growth companies. So that framework really, I was in venture, and then coming out of that in 03, 04, started, private companies financing windows started to open again. But then I started looking at the public markets, and the period of 98 to 2000, a whole bunch of companies had gone public. And fast forward to 2003, 2004, most of them were totally stranded and left for dead. There was no investor appetite whatsoever. And the companies that had survived was because you had wonderful management teams in there focusing on driving revenue, growing profitability, and mitigating that equity dilution risk that I mentioned was the key risk at the beginning. And so that really got me. I could go into the public markets and find companies trading at depressed valuations compared to what we saw in the private markets that were also more mature. So 20, 30, 40 million of revenue, cash flow, balance sheets, and you always ask yourself, I sure wish I could buy a growing tech company at the value of the cash in its balance sheet. And well, careful what you ask for, because we hit that point again. We hit that point again last year. So you get older and you see a lot of these things, and history starts to repeat itself.
Yeah, exactly. If you've been around as long as I have, or as you have, you do. Experience it becomes valuable. So why don't you quickly just tell us more about Pender Fund and the work you guys do there?
Yeah, so we started in venture, and what I always talk about, particularly, I run our small cap strategies. It's really our private equity approach to public markets. And for us, that is digging in, getting to know a business incredibly well, understanding the unit economics of that business, what the growth potential of that business is, talking, getting to know the management team, and getting a comfort level on their ability to execute and grow the business over the long term. So it's really like, it really ties in with one of my favorite books on investing, which is Phil Fisher's Common Stocks, Uncommon Profits, where he's in the public markets talking about his scuttlebutt approach to public markets. And if anyone's a micro cap, small cap investor, and they haven't read that book, it's mandatory reading. You're not allowed to buy another stock until you read that book, because
exactly.
Like, you buy 10 stocks, get to know the companies incredibly well, go talk to competitors, suppliers, particularly micro cap. Like, there's no sell side coverage, and big analysts aren't buying these things. So we can have an analytical edge in this space. Individual investors can have an analytical edge as well, because you can uncover interesting information that can either confirm your thesis or tell you to get out. So, our investment process here on the small cap side is really driven from that background in private equity, because, in the private world, if you buy a company, you're, whether you want to or not, you're there for 10 years. Like, you can't just wake up the next morning and hit the sell button. You need to actually, you need to have the conviction you want to own it for 10 years, which is a way different level of due diligence than what you do if you're thinking of buying Microsoft or Google today. So that's really the fundamental underpinning of our investment process. Of course, that's, buying the right company is part of the equation. The real, the Lollapalooza is having the compounding effect of the underlying business. And yes, you can buy a great business and buy it at the right price. But how does that company grow in value over time? And, helping, talking to management teams and, helping them grow their businesses over time, really gives you a bit more of an edge in terms of the compounding process. And I guess finally, the final part is, you always have to begin with the end in mind. And, you buy a stock at $1, you only make money if you sell it for more than $1. So who's going to buy the company at the end of the day? If you're a smaller investor, it's, the market can quite often take you out. If you're a larger investor, like we can be sometimes, sometimes the market will take us out, but other times you really have to ask yourself, what's this company worth to another company, and who's going to buy it at the end of the day? So really having that M&A lens when we're looking at these companies.
You wiped out 4 of my next questions. I really love the fact that you mentioned so many cool things in there. M&A approach, private equity approach. Let's drill down a little bit more on that. When you look at a company, what makes it sort of fit that private equity model or M&A type model? What are you really looking for in these individual companies?
Yeah, we should get my partner Maria on. She would articulate this incredibly well. But it's people. Our private equity approach is really people, product, and market. And so when we're looking for these companies, is it a great product? Is it able to drive great margins, and does it have demonstrated product market fit? Like, we don't, when we're getting involved in micro caps, we don't want to take on the risk that, hey, it's a great fly trap, but maybe nobody buys it. We want to know people are buying it, and we want to know they're buying it for a strong ROI reason. And then, the next is, how big is the market? It's, the real home runs are made when, you got a product with great unit economics. The company can scale, so it's got really strong return on invested capital, but it's got that long runway. So the big market is really table stakes for finding these home runs over the long term. And then the people side of it, you can't do a good deal with a bad person. So you really have to have confidence that you trust the people who you're investing in. You need to read through the info circ and all the proxies and understand the incentive structures. Is the CEO a big shareholder, or do they have a big salary with a whole bunch of options? Really understanding how the management team is aligned with shareholders at the end of the day. So those are the 3 areas we focus on. And on the private side, we'll spend months figuring out all that information. On the public side, it takes us 1 to 2 months to get through our analysis and understand if we want to take a position and hold something for the long term.
Mm-hmm. It's interesting you say that. So you're looking at private deals as much as you're looking at public deals, and really, what I've always felt is there's not much difference when you're looking at these companies. If you take the private sort of acquisition approach and lay it into public companies, it's not that different. You're buying businesses, right? You're not buying a slip of stock. You're buying businesses. That's what you're trying to do, right?
Yeah, well, that's what we sit around the table in the investment team, and we all talk. We're all business analysts, and there are public companies and there are private companies, and the fact is they all have customers, they all have people working for them. They can all be analyzed based on their gross margins, their growth rates, their return on invested capital, and the market potential. So the analysis is totally the same. There are definitely nuances. And in terms of how you can actually execute both strategies. I mean, the great thing is I can buy a public stock, even if, the management team doesn't want me to. If the management team doesn't want you in their private company, it doesn't matter what you do, you're not getting in. So
good point. Yeah.
It is a different process, but at the end of the day, you're right. Yeah. It's just, we're all just buying businesses. Maria and her team focus on the private side. I gravitate towards the public side just because I love Mr. Market. 2020 was just a classic example where, what small cap indices were down 42% in the middle of March. And by the end of March, they're back up 20%. Like it was 80% peak or trough to peak swing. Like when you have opportunities like that, where you've got really irrational sellers and buyers entering the market any given day, it makes this a lot of fun.
Yeah, no, absolutely. Why don't you tell us a little bit more about your actual process? Like, how do you find your ideas?
This is pretty boring. A lot of it's just recycling and accumulated knowledge. I've been looking at small cap Canada since the early 2000s. There's companies that have been public since that time, and I've probably met with management teams 10, 20, or even 30 times over that period of time. So for us, it's really getting to know these businesses over time, so that we can have conviction in our analysis and what we think of the company. So it does take us a while usually to get to a point where we will buy a company, and it's the culmination of a lot of time spent both doing independent research, but meeting with the management team and the company, and I think one of the differentiators between large cap and small cap investing is, in large cap companies, you've got all the transcripts and companies have been public for a really long period of time, and you can kind of read through the transcripts and, management says they're going to do something and you can figure out if they did it or not. You don't have that data available in the micro cap space a lot of the time. A lot of times companies don't have conference calls. And so how do you know if management's actually conservative, if they're able to forecast correctly, if they're achieving their objectives? So a lot of our times we'll be talking to management teams and trying to understand what the objectives are, and then when we meet them a year or two later, we can measure them against that and get a feel for if they are on track or not. Because management teams that tend to under promise and over deliver, we find those teams tend to create more shareholder value at the end of the day than those who overpromise and underdeliver, which there's a lot of them in microcap Canada. So you got to be careful.
Yeah, I'd say that's the majority of them. I'm trying. What would you say is the top 3 things you look for? And how can sort of a retail investor, smaller investor, view that, or what do you look for? Is it growth? Is it profitability? Is it does it change? What do you really look for?
Growth is the number one driver. Because if you get the growth rate right, it can hide a lot of errors in a business. Like if a company is growing at 20 to 30% year over year, they can make some bad hires, they can launch some bad products, and the market won't really notice. But then if you get the growth rate right, and then the unit economic, then the gross profits follow, and then the operating profits follow. I mean, that's like, when people talk about the big micro cap home runs, though, that's where you find them. It's where you get the growth rate right, and then the economics come through at the end of the day. And I think where, the second part of that is the second level is, finding the companies that are structurally not profitable, like, or they're reporting that they're losing money or whatnot, but we have an incredibly high level of conviction that they will turn profitable and will not need to raise capital again. And because that's where, if you get a high growth company that's trading at a distressed multiple, it re-rates to a normal course business, but then you also get the growth rate. And that's where you really find the 10 and 20 and even 100 baggers in the markets. And I mean, I'll sound like the public library here, but like, there's a book, 100 Baggers, out there. Chris Mayer wrote, and it was originally 100 to 1 in the stock market. And, it talks about like the two key opportunity sets for where you can find 100 baggers in the market. And, small cap companies, when they're trading at depressed valuations, is one really fertile part of the market. The other is actually distressed debt, where a lot of times companies will restructure and whatnot, and you'll end up owning the equity. But, I certainly focus on the small cap side, and you get these periods of time like what we have right now, where unprofitable high growth companies are trading like they're going to go out of business, and some of them are, but the ones that make it out the other day, that's going to be maybe not the Amazons of tomorrow.
Let me ask you one more question on process, and then we can start talking about some fun stuff. Do you consider yourself a top-down investor or bottom-up investor?
I'm bottom up, so we're always trying to just pull companies apart and understand the business model, and why customers would buy the product. How is that product going to scale over time? What are the customers saying? What are the competitors doing? But where top down does come into play is on the growth side, and it's so much easier when you're investing in these companies that have a tailwind as opposed to a headwind. So if you're in a high growth market, or like right now, we don't do much on the energy side, but we expect CapEx and expenditures for energy companies to increase over the next couple of years here. And there are companies that sell into energy companies that are going to be the beneficiary of that for the next 3 to 5 years. So that's kind of how we would look at things from a top-down perspective, more from an industry and a revenue opportunity perspective with the companies we're invested in.
Yeah, no, I agree. It's interesting. Same thinking that we have. We prefer to, provide the shovels to the miners rather than the miners themselves. Well, let's talk about some of the stuff you're seeing out there right now, as far as just generally, let's say, trends. You sort of mentioned one right now, but where else do you think investors should keep a strong eye on right now, as far as different trends in the industry?
So, I think there has been this cyclical underinvestment in resources, which is going to lead to a lot of spend in energy, but also mineral exploration and development. So that's one area we are looking at. We see what's going on in Europe right now with Russia and Ukraine, and the push to renewables is going to continue to increase. So we think there's a big tailwind in the renewable space, and we've done a bit in that area over the years. Renewables tend to be very capital intensive, so it can be hard to find a capital light business model where you can really get the leverage for the long-term returns. But that's another area. And then I think one that's actually really near and dear to North American small micro cap companies in particular is reshoring. So I think with the breakdown in global supply chains throughout COVID and the last few years, we're going to see more companies move manufacturing, move production back into North America to gain control over their supply chains again. And big companies can announce big capital spends. Small companies can do stuff quickly. So I think there's a real opportunity for small cap companies to take advantage of this situation. And I mean, that's, kind of ties into, one of the reasons we love smaller companies is you've got more nimble management teams, which can make decisions quicker to capitalize on these opportunities. And it's generally why when you see economic uncertainty spike up and you get inflation or recessions or whatnot, it's the small cap companies that are able to adjust more quickly and then lead coming out of these periods of time.
Yeah, you know what? That's a theme that we see as well. I 100% agree with you as far as the sort of relocating logistics and supply lines back into North America. I think I think you're spot on there. The part of the market, or whether it's nano caps, small caps, large caps, I mean, you tend to work in most of those areas. Where do you think the sweet spot is right now? Is it finally in the small caps or the smaller companies, or are we still going to see massive amounts of funds go into highly liquid, well-known names that everybody seems to want to chase for so long?
The only thing I've got more wrong on this is the Vancouver housing market. We've seen this rotation out of small cap and into large cap, and it's really been driven by monetary policy. I mean, as interest rates go to zero, it went to zero. There's so much liquidity in the system. It chased bigger, more liquid pools, and so for the last 4 years, I've been talking about how the opportunity for small caps relative to large caps is better, and every year it keeps on getting better. And so, I mean, I'm a little shy to say this is the best time in history, but we're sitting there on a relative valuation basis, small caps to large caps. This is the best we've seen since 2002, 2003. It's on par with what we saw in March of 2009. So we're in crisis levels of valuation where small caps are more favorably valued than large caps. Like if you look at the headline numbers, like right now the S&P 500, last I checked, was about 17.5 times next year's earnings. S&P 600 small caps trading at 13.5 times. And historically small caps trade at a premium to large caps. And then you look at the 5-year consensus EPS growth rate, and S&P 500, it's about 9.5%, and on the S&P 600, it's 12.5%. So you're getting a way cheaper multiple for a way higher potential growth rate. And so, I mean, the setup for me looks pretty great right now, but like I said, I've been banging this drum for a while, so I'm a little shy to get too aggressive shouting it out loud.
Yeah, no, I hear you. I agree. I mean, that's something we've been saying for a while now as well, that the valuations we're seeing in the, we play even smaller than what you typically play in, but the valuations, I haven't seen anything like this since, at least, I'd say 2009, 2010. So I'm with you. I'm happy to hear that smarter people than me are agreeing. Let's talk a little more specific. Any companies you want to highlight, or anything that you think it makes more sense for investors to take a good, at least a serious look at?
Yeah, I mean, there's definitely tailwinds out there. There's also risk out there right now. We have had this interest rates increasing, recession going on. So it's not going to be as easy for companies, and I think that's good for all of us because we're active stock pickers, and we're trying to figure out which companies, which are the good ones and which are not. And so for us, I mean, we're looking at companies that have more more resilient revenue streams, where we know the customers are going to continue to use the product, they're going to continue to pay for it, and there's a really strong ROI reason for customers adopting the or buying the product. And so that we probably shying a bit more away from consumer driven companies at this point in time, focusing more on companies selling into traditional, more boring industries. I mean, Copperleaf, which is a huge big holding for us, we're a very big shareholder of. I mean, they sell, mission critical software for the capital planning for utilities around the world, and they've never lost a customer. So when we think about resiliency of business models, when you can say a company's never lost a customer, and it's key to the annual planning process for the company that's paying for the software, that's a pretty good place to be starting in companies like that.
Gotcha. And Copperleaf, the symbol, I think CPLF, if I remember correctly. Is that right?
Yeah.
Trades on TSX. Okay, gotcha. What else? Where else are you looking?
I mean, I kind of started off talking about how we saw this period of time is very akin to the sell-off in the dot-com boom in 2002, 2003. So, it's going back, the unprofitable tech companies have sold off dramatically. I mean, Copperleaf hit like $25, $26 and is trading at $5 today. Was it worth 25, 26? No. Is it worth $5? No. So, we've seen that right across the board with a lot of unprofitable tech companies out there. So really, that's where we're sharpening our pencil. And, we had this great IPO period where we met with a ton of these companies, and a lot of them were uninvestable, particularly from a valuation perspective. Some were uninvestable because we didn't like the business. But now a lot of the businesses we did like, where we didn't like the valuation, that's where we're seeing opportunities. And, another darling was Thinkific, which is a platform for online influencers to monetize course content. And it's got about I think it's $1.50 a share of cash, trading about $2 a share right now, and has been growing at north of 20%. Obviously, 2020, 2021, they had a massive tailwind as we had a whole bunch of people moving online and course creation going online. But we think over the long term, they'll continue to grow, not at their historical 40 or 50%, but, 20% plus, with a business model that was profitable pre-IPO. They overinvested for growth. They've restructured their workforce. So high probability of getting to cash flow positive in the next year, really strong balance sheet. And if you kind of look out 2 years, if, the company's grown 20% year over year, is profitable, has a fortress balance sheet, it's certainly not going to trade at the valuation it is and multiple it is right now.
What do you think is, I'd say, change that? You're an institutional investor. One thing that we talk a lot about is where the institutional investor is sort of in the food chain, I guess. Are groups like yours moving up market? Are you staying down market? Sort of what, if anything, what level or market cap do you sort of use as the cutoff line?
Me, Paul. I'll look at it.
Yeah, I know. I want to hear from you, though. I want to hear from you. Yeah.
Talking to other, I'd be talking more to kind of earlier stage small cap managers or hedge fund managers. So, hedge fund manager will restrict capacity so that they can come down into $50-100 million companies, or someone who's launched a small cap fund and is looking to scale it up, they can do some of the smaller stuff earlier on. So, you start to see institutional interests at 50, but more like 100 million. 250 million is, I think, where market cap is where you start to see, larger institutions come in and play. So, which is great for all of us microcap investors, because if you get it right, you've got a natural investor base that's actually going to re-rate the stock and take it higher for you.
I think big process for investors is really understand the typical criteria that these buyers are looking for, and it's growth, it's somewhat decent valuation, and then just size. If you can catch those threes right, you got a willing buyer that's going to take it off your hands if you want to.
And I would lump profitability in there too. I mean, because if for a manager that's taking, they're starting to follow a company at 100 or 250 million, they're going to have a lot more confidence if the company's profitable than if it's not, because it's not going to be a big part of their portfolio, so they can't do a massive deep dive on it to figure out what their real business risk is. If it's profitable, they can probably get there a little quicker. So I would lump that in.
Yeah,
but
good point.
We've certainly seen.
Hey, Trev. Do we lose David?
Hey, David, you're muted at the moment.
My mic went off there.
No worries.
There you go.
Yeah, we missed that segment, so just back it up about 20 seconds. Yeah.
So I think if you back up, a lot of small cap managers have wound up their shops over the past decade. So there's a lot less institutional small cap investors in Canada than there was 10, 20 years ago. And the other structural aspect of it is the consolidation of wealth in the banks in Canada. So we've got 6 banks, and advisors are running. They have client bases larger than my small cap fund, and they're just not coming down. Historically, an advisor would run their own small cap portfolio and pick 5 or 10 stocks, and they can't do that anymore. And so a lot of the traditional participants in the small cap space are not there anymore. And some people view that as a good thing, but as some famous guy in Omaha once said, all I want in life is either an unfair competitive advantage or no competition. So the less people investing in the space, the way better off we all are.
Absolutely. Yeah. That's cool. But why don't we give you a chance to brag a little bit? Talk about some of the past successes that you've had, and ideally what you learned, or what was the key driver of that success.
You like making me feel uncomfortable, don't you, Paul?
Of course. Well, I'm also going to ask you for some of your losers as well, so we'll balance this out.
I'm way better talking about those because they grate on me. A couple of our winners over time. One great investment for us was a company called QHR. It was a small little electronic medical records company. It's based out of Kelowna, BC. Great advisor at Canaccord introduced me to the stock right kind of early stages, and I looked at it, and the company had just made an acquisition, and I was looking at it, and I'm like, they can't pay for it. They're going to go bankrupt. So I kept on following it, thinking we might actually have had a chance to buy it out of bankruptcy. But the CEO came in and he's like, no, like I've got this receivable coming in here, and this is going to happen, and that's going to happen. And I didn't know him that well at that point in time. But 6 months later, he comes back and he's still alive, and it played out exactly like he told me it was going to. And so I just, Al's, a wonderful entrepreneur. And so at that point in time, we knew we had a special entrepreneur there. We did like the business model and the market opportunity. So we bought the stock, and I think is, somewhere, we bought between 40 and 60 cents, and continued to build our position over the years. I think that was like 2010 or 2011, and continued to support the company. And right up until 2016, I think, it was sold to Shoppers Drug Mart for $3.25 a share. So it's pretty good turn over a 5-6 year time frame for us. But that was really, we bought a company at a good valuation, and then the company executed, built out their recurring revenue. So the majority of our gains were actually driven from just the business creating the value inside it, and us just holding on and supporting that business for 5 or 6 years.
So let's flip it around. What's one of your losers, and more importantly, what you learn from one of your bad picks?
I got a recent one for you. A company called Inscape. It's an office furniture company. and it historically had done between 50 and 100 million of revenue, and would kick out a little bit of free cash flow in good years and lose a little bit in bad years. But we were able to buy the stock for 65 cents ish, and they had a hidden asset on the balance sheet. They had this real estate in Northern Toronto, which we thought was worth close to $30 million, which translated to greater than $2 a share. And so we just thought we had a tremendous margin of safety built into the purchase. What we underestimated was how bad that office furniture business was. It was severely underinvested in for a long period of time, and then you tie into having COVID happen. Not much office furniture has been sold since 2020, as you can well imagine. So it was pretty detrimental to the business, and because of how bad the business got, it blew up our margin of safety. So that was not a good one for us. Key takeaway is just focus on business quality. In the beginning, you asked what I really look for, and looking for growth. And if this, this may have been different if this company was a growing value. Well, it would have been different if it was a growing value creating enterprise.
Gotcha. So on that note, like when something's going wrong, it's easy when things are going right and somebody comes and buys out your company, like Shoppers Drug Mart did. When it comes to selling, when and how do you sell if something is not working out for you?
You sell as early and as often as you can.
Simplicity. Yeah.
So, once you recognize you want out, you try to figure out how to get out, and there's different constraints. If you're running your personal account and you're a small percentage of a company, you hit the bid and you get out as fast as you can, and do not nickel and dime. If you're exiting something because you don't believe in the thesis, it doesn't matter if you get a penny more, because if you're right and then things aren't working out, you're going to get a lot less. For us, we can accumulate larger positions in companies. So in order to exit our position, sometimes we'll have to go to the board and say, hey, we actually think the business should be sold for A, B, C, and D. And sometimes they agree with us, and then we'll work with them to help sell the company. If they don't agree with us, then we either have to try and get out in the market, or convince them more forcefully that selling the company is the right thing. So how big a position relative to the company is an important point there.
Right. Gotcha. Remind everybody, if you've got some questions for David, we're going to open up the mic a little bit here in a little while, and feel free to ask David as many questions as you can here. So we talked about some of the areas that you think we should look at, some stocks we should look at. What do you think are areas to avoid right now?
Areas to avoid. Is crypto too soon?
Yep. Too soon. Never too soon. Never.
There's while we believe blockchain technology is really interesting. There's a lot of practical use cases, and there's going to be some great opportunities there. Capital cycles, it's going to be hard slogging for a while. So while we're following the space and trying to figure out which companies we want to invest in 3 years or 5 years, we're not there anywhere near it right now. And there's a lot of bad actors in the space too. So a lot of work needs to be done there. So it's just not worth treading into right now from my perspective. That would be kind of the big area. And then Canadian consumer, interest rates going up. In the US, everyone's on a 30-year fixed mortgage now. If you had any financial sense. In Canada, everybody's on 3 to 5 year variables, and it's impacting cash flow. So Canadian consumer focused companies is not a big tailwind right now.
Gotcha. Okay, maybe one last chance. Any other ideas that you like out there right now? And maybe even asking you, we've talked about a couple Canadian companies. Do you see more opportunities in the U.S. right now, or do you see more in the Canadian side? Where does the ground look a little bit better?
So our like top level like valuation perspective, it's fairly consistent. There's a lot of great opportunities both in the U.S. and in Canada. For us, just wanting to go deeper into companies, we have a bit better access in Canadian companies. So we just, in times like this, we tend to focus more Canadian than US. And like the US is a deeper market, so there's a lot more opportunities there. About the same on a per capita basis. But we just gravitate towards Canada because when the opportunities are here, we come here. And like what you would have saw though was 3 years ago, we were a bit more focused on the US because we'd had this big, a lot of great Canadian public tech companies had been acquired between 2013 and 2018. And that really forced us to go find opportunities down in the US. But the IPO window we saw in 2020, 2021 really repopulated that universe for us. So there's just a lot to do here in Canada.
Mm-hmm. Gotcha. Why don't we open up to questions? You get to handle a few questions coming in?
I'll do my best.
Perfect. I see Oil God. Oil God, I don't know if you're muted or not, but anything you want to ask or any comments you have?
Yes, thank you for that, Paul and David. Fantastic presentation. My question is more on the fact that I love your comments. The smaller companies are obviously more financially vulnerable than, let's just say, larger companies with economies of scale. And so you've got the 7%, 5 to 7% interest rate world. You were just talking about the Canadian consumer. Do you think that has any bearing in sort of this change? You were talking about earlier, perhaps renewables and sort of a new era of investing, for example, in energy that may come. Are you seeing smaller companies that are actually making headway? Or are you thinking that with 7% interest rates and an economy that's really not yet, in a position to adapt to higher rates, are you going to be seeing this sort of, are we going to be going back to traditional fossil fuels? Or are you seeing sort of technology is going to be breaking through this? I'm just kind of curious to know your position here with such a high interest rate and such a vulnerable Canadian economy.
Yeah, I mean, there's a lot of facets to that question. So we're doing some multivariable problem solving there, which is always challenging. I won't get into a politicized fossil fuel debate, but I just think there is so much pressure towards moving towards renewables that tailwind will continue. And I think what that does tie into is there's bad actors around the world who control a lot of oil, which is driving that. I also think in the short term, if you want to have the most ESG compliant oil fossil fuels out there, you should be pretty much in Canada because I know oil sands are not all that great, but environmental regulations are more strictly enforced than a lot of other jurisdictions around the world. So I think there is that opportunity. Like I think it's not either or. It's probably a combination. Does that answer your question?
It does answer my question. I know it's a very difficult question. I've been looking at a few different businesses that may be in the right side of sort of climate change, if you will. Have you heard of a Canadian company called Ecosynthetics by chance?
Yes, we have. Yeah, it's a company we look at and follow.
Okay, and I assume you can't offer comments on them, or no?
Compliance gets really mad at me if I talk about companies we don't own. So I'll have to refrain.
No problem.
Sorry about that.
Of course, no problem. Send our regards to compliance. I mean, of course, we all have to stay in business. But I agree with you that the Canadian energy space is the way to go. Maybe I could ask you to follow up on a comment you made earlier with you're expecting them to spend more money in the future. Did you mean sort of the service inflation and sort of, or are you actually expecting E&Ps to ramp up because of TMX? Can you sort of comment, clarify what you meant earlier with respect to spending more money?
I think E&Ps are going to ramp up.
Okay, thank you.
Is that? I don't.
Sweet and simple.
I don't know if I need to expand on that. I think it's the world is we've underinvested in production for a bunch of different reasons over the past few years, and that's coming home to roost. And then I think there's a great book called Thinking in Systems. That I think once the spend starts in E&P, there's going to be a whole bunch of positive feedback loops. I know everybody is very returns focused right now in energy companies. It wasn't so long ago they were not. I think there's going to be more capital once capital starts flowing into the sector. There's going to be positive feedback loops for it to flow back in. So there's going to be increasing spend for a while.
Okay, so David, you've given me the opening then. Where's that capital going to come from?
I am a capitalist at heart, and I just think if people start making money, they're going to want some of that. So if you look at structurally, there's been a move of capital from basically Canadian equity to global or U.S. equity for the majority of Canadian investors. And, part of it's basically selling 5 banks and selling energy stocks to buy global multinationals. Last year, we saw energy stocks like the Canadian indices outperform because of energy stocks primarily. Once people start hearing that Canadian equity is outperforming, they're going to rotate into it. People are going to buy more energy stocks. Those energy stocks are going to go up. It's going to be the exact same positive feedback loop, which is fueled kind of NASDAQ 100, S&P 500, and mega cap stocks in a much smaller way. But I'm just simple. I just think people like making money. And if they think people are making more money than them, they're going to do what those other people are doing.
I agree on the individual level. How about your comments of your competitors, the institutions out there, the Quebec pension plans that have let's say got rid of fossil fuels and have tripled down on Facebook and things that have fallen on the face. You're starting to see an appetite change in the institutional side, or is this largely something that you think it's going to be people on this call?
It'll be retail driven. It will be unsophisticated investor driven. It will be hedge fund driven, and it's there are select institutions which I think will probably never buy fossil fuels again, but there are others that will.
Wonderful, Paul. Back to you. Thank you very much for entertaining me, David. That was excellent.
Thank you so much. We got another question or comment from Carlos Valadez. Carlos, take it away.
Hey, how's it going? Can you guys hear me well?
We can. Thanks.
Yeah. All right, awesome. Yeah, so I just have two, kind of more simple, quicker questions. So the first one is, when it comes to these like small micro cap like stocks, right? I noticed that a good chunk of them have like very high year over year like share dilution. So I guess my question is like, how do you approach these when you find that they're like, I understand that it's necessary sometimes to dilute shareholders and like raise funds, but like, is there like a cap that you're not willing to go above, or like how do you approach these like high dilutive stocks?
So, I mean, the world is gray, but we tend to shy away from companies that are growing their share count excessively. And usually, particularly in the microcap space, it's because companies are raising capital to fund operations, and they're not structurally profitable. And that can work out if you can become structurally profitable and grow. But if you have to continually raise capital to finance operations, it's probably an indicator the quality of the business. So we tend to shy away from those, but this could be a leading question because we do invest in companies that do issue shares frequently. But and then when we do, it's very much, why are they issuing the share? And you're giving up a percentage of your company when you issue a share, but what are you actually getting in return for that? Mm-hmm. And sometimes it can make a lot of sense. Other times it may not.
Okay, yeah, I was just curious because that's something that I'm like, it's my weakness. I when I look at these companies, I make sure they're like, very consistent or buying back shares or very small, share dilutions. And sometimes I'll find value in stocks that are just diluting like crazy. And like you said, it's a gray area. So it's just like, I just wanted to know if it's like, if I've been doing it right, like just trying to avoid them, or if it's like, no, sometimes you see beyond that.
It's generally a good filter. I mean, if you're investing for your own account, you only need like kind of 5-10 stocks, right? So you don't have to go into stuff like that. And companies that are issuing a lot of stocks, there's a lot more accounting games they can play with M&A and classification of accountings of their accounting. So there's a lot of not just like a business quality issue, dilution risk. There's actually there's some pretty significant other risks as well.
All right, sweet. And then the other quick question was, I assume, you use a margin of safety. I mean, do you use one at all or no?
Yes. So,
okay.
Yeah, like I'm a value investor. I don't like saying that because everybody thinks I'm buying like broken down companies for 50 cents on the dollar. But for us, it's all about, what's the private market value of a company? So what is another company going to come and buy this company for today? And then can we get it at an appropriate margin of safety? And
okay. So that was my question. I was just going to ask, like, if you're more focused on, if you value a company and you're like, hey, right now it should be worth around $10, but you could also come up with like a future valuation, like, but in the future it can be worth $18 or it can be bought out for 18. So I was going to ask, like, are you more focused in like getting a margin of safety based on what it could sell for today, or like, what you estimate it could sell for in the future? Because, that could be a huge difference. But yeah, that was pretty much it.
Yeah. So I answer this one, and this is how I answer this questions internally all the time. It depends. It depends on the growth rate, right? So, if you think a company can be worth $18 and you're buying at $10 today, what is the probability of the execution of that? So yes, you're getting a margin of safety to the future value, but what is the risk associated with that? If a company's not growing, then you're going to demand a higher margin of safety on your purchase price than what the company's currently trading at. Does that make sense?
Yeah, makes sense. Yeah, that was pretty much it. Thanks, man. Appreciate it.
Perfect. Thanks, Carlos. Dave, you brought up something interesting. Are you seeing what we're seeing in that we're finding a lot of publicly traded companies now that are trading at lower valuations of some of the private comparables, and that's traditionally not what happens. Are you seeing the same sort of thing?
Yes, absolutely. And that's why I think, we're probably close to an M&A cycle uptick here, because, a lot of private companies are looking at these companies saying, well, I can buy this for less than what I'm transacting at in the private market, and it's highly accretive to what I'm doing. So absolutely seeing this.
Fantastic. Very cool. Well, do we have any other calls coming in? Questions? I don't see any here.
Paul, may I ask one more?
Sure. Yes, please.
So, David, you're obviously not immune to global headline risk, and you're seeing equity valuations and volatility and whatnot. You're asking people, maybe not today, but in general, your business is one that is going to be in probably one of the more volatile spaces in the market outside of tech and crypto and all that. How do you sort of reconcile people's fears out there and sort of this volatility you're seeing in the market with probably the patience you'd want your investors to have when you steward the capital?
Oh, you just asked the $1 million question. That's the hardest thing we do. And I think we're in a fortunate space because we've been doing this for a while. We've been through some pretty volatile markets, but it's absolutely, it is challenging because, you know, there are days where I'm the happiest person alive because I jump out of bed and there are 10 stocks that I know if I buy them today, I'm going to make a whole bunch of money on over the next 5 to 10 years. And at the same time, I know there's investors who hold the fund I'm managing that are, you know, really nervous and thinking about selling their position at the wrong time. And, you know, I think the best thing we try to do is communicate our process, how we invest, how we, you know, we're always trying to figure out what a business is worth today and buy it and hold it at a discount to that. And over the business cycle, we'll be okay. So we try to communicate constantly, but it's, I mean, you're speaking of the reason I think Peter Lynch quit the business is he couldn't figure this out, and he's a lot smarter than I am.
We'll see. Awesome. Will, got anything else on that question?
No, that was fantastic. It's a very difficult yet loaded question, right? And I know David would know better than anybody that investing is a lot easier than it sounds, and the psychology that you have to investing is definitely a lot easier than it sounds. And so the more confidence you have, and if you don't have it yourself, for the people on this phone call, you know, David seems to be an absolutely, what we call a banger for a steward of capital. David, you're going to have my money one day, and I look forward to working with you.
Oh.
Awesome.
Thanks for the big vote of confidence. Appreciate that.
Yeah. Great. Okay, we've got Tom. Tom, do you have a question or comment for David?
Thanks, Paul. Thanks, Dave, for taking my question. It's on Well Health Technologies. Looking for your outlook on that company. And I'm also curious about, if I'm reading it right, there doesn't seem to be a lot of institutional interest in the business. If you look on Yahoo, for instance, or Ticker, it doesn't show a lot of institutions involved there. So just curious why you think that is as well.
I think what we've seen, you know, obviously, you know, 2020, 2021 were, you know, Well was a darling, you know, raising capital and pursuing an acquisition strategy. And I think, you know, when we talk about exodus of capital that we've seen from the COVID winners in the past 18 months, companies that were growing through acquisition were hit a lot harder than others because, you know, when you stop growing by acquisition, that's when you know, you can see what you know, it's like when the tide goes out, you can see who's swimming, right? So when growth by acquisition stops, it really lays bare the fundamentals of the underlying business, and a lot of investors have basically just exited that space. And so I think Well Health, which grew through acquisition, a lot of the institutions just said, we're just going to go to the sidelines and we're going to wait to see what this business looks like underneath. Once you've got like year over year comps, you can actually figure out the economics of the M&A strategy. So that I think that's why a lot of institutions have shied away from the company. We obviously own it, so we think they're probably on the right track. Does that answer your question?
Yeah, thanks a lot. That's great.
Gotcha. Okay.
Yeah, I would just add one more thing. I think there was a lot of high flying healthcare companies, a lot growing through acquisition, and Well acquired one in particular, which was a pretty large cash flow generator. So, it has more stability and the ability to grow in its way into the acquisition strategy than some of the others had as well. So I would just add that in.
Fantastic. Okay, if there's not any other questions or comments from anybody else, why don't David? Why don't just any final comment or sort of parting message or anything? I mean, we've got a lot of let's say retail investors that are listening, any words of wisdom you want to make sure that they leave with?
I just, I speak to a lot of individual investors who run 5 to 10 stock portfolios, and they've accumulated significant amounts of capital over a really long term. And that's just by buying high quality businesses early in the compounding cycle and holding on for a long period of time. You don't need that many in your portfolio. But the key is, to do the work and have them in your portfolio. And it could be a fun ride. Yeah,
absolutely. That's why we get up in the morning and enjoy doing what we do. There's always something to sink your teeth into and ideally hold on for dear life. There's always one, right? I keep thinking you just got to flip over enough rocks, you'll find one that'll change your life. So it's fun looking. David, your Twitter handle is @PenderDave. I'm going to suggest everybody follow David. He's always got neat little words of wisdom and ideas he puts out there. And your website, I think it's penderfund.com, if I'm not mistaken. Is that correct?
It is, yes. Yeah. It's probably not as excited about small caps as I am, though. So Twitter's way better for that.
Perfect. Yeah. Perfect. Well, this is great. Listen, David, I always enjoy a chance to talk to you. Great steward and evangelist of the industry here in Canada. So happy to have you on, and I'm hopeful that we can do this again at a later date and come up with some more good ideas.
Yeah. Well, thank you, Paul, and I love yourself and your community, and when you talk about sources of ideas, you do great work. So know that I'm always watching. I love co-investing.
Perfect. And we'll have to step it up a little bit knowing that you're watching. I appreciate that.
All right. Thanks
awesome.
So much, everyone.
Thanks everyone for joining us, and we'll catch up with you soon. Bye for now.